Welcome to this edition of an economic update put out by Elliott Wealth Management. I am one of your hosts, Christopher Calandra. I have joining me Marshall Rosen. For those of you who are clients of Elliott Wealth Management, you should know by now that we executed a merger on January 1st, 2024. So I invited one of the partners at Creative Financial Network, my new friends and partners, to join me on this discussion, looking ahead to the economy in 2024. So, Marshall, thanks for taking some time to discuss the economy and the outlook with me.
Thanks, Chris. I'm excited to be here. This is early in our partnership, and I'm really enjoying working with you here.
Yes, it's been, we have a lot to do, but there's a lot of opportunity and a lot of good stuff going on. So the agenda today, we're going to talk briefly about the equity markets in 2023. I want to cover inflation, which I still believe is a central economic story. Talk a little bit about recession fears, the idea of a soft landing. I want to cover some key reasons that we feel there's optimism about the economy and by extension, the markets in 2024. I want to pair that with a discussion on some reasons to be worried, things that could derail what might be a good year, and then cover a little bit of thoughts about what we might expect in an election year, this being a presidential election year. So kicking it off, the equity markets, Marshall, huge year for the markets, big rebound over what was a very difficult 2022. What are your thoughts about what we saw last year with a big move up, the S&P 500 up over 20%, Dow up over 13%? What are some of your thoughts?
Well, the public had a lot of concerns about the ups and downs of the market. I think people tend to forget that that's what markets do. They go up and down. But, the green line shows exactly what happened. It went up for the year. It was a great year. We had some concerns, in late October, early November when the market took a little bit of a dive. But that's expected, just as it did, back in March. Those are normal things where people react to something. And we have to remember, we invest for the long haul. We're not day traders. And I thought it was a great market. It was a great year. And I would take this chart every single year.
Yes, and I believe it caught a lot of retail investors, our clients, by surprise because of the doom and gloom about inflation and other factors going into this year. It's really something that was not expected by retail investors. And candidly, a lot of the talking heads you see on TV, this was, I think, largely unexpected. Not that it was a bounce back year, but how strong it was. And I mentioned at the beginning, the central issue, or one of the central issues, I think, has been inflation for a while. I anticipate it will be as we move into 2024, because we've seen a significant downtrend in inflation. As you know, Marshall, and listeners probably have heard me speak on the Simply Financial podcast, or if you're in a client during our various discussions, but inflation peaked probably somewhere in the summer of 2022 when it got to over 9%. I think it was 9.1%. And since then, it's been trending downward steadily. And that is a big reason in my mind why the market did have such a strong rebound last year, because we're now at a manageable, although still problematic, inflation level that's somewhere between 3 and 4%. The Fed wants it to be at 2%, but at least it's in striking distance. And I think most people feel, as do I, that it was hard to imagine that we could have gone this far, this fast, given where we were in mid to late 2022. What do you think about inflation? What's happened over this recent stretch?
Well, this is part of a normal cycle. It certainly wasn't as bad as it was in the early 80s when we saw 22% interest rates. And inflation and interest rates are obviously tied together. Yeah. And I think that the public has forgotten that there is inflation and there'll always be inflation. And we had such low for so many years, where people started to think, again, interest rates and inflation together, that, a 2.5% mortgage rate was normal. It's not.
Yeah.
5 to 7 is the normal range. If we go back, long time, we get used to it. And people need to adjust their thoughts that going forward, over the next 50 years, 5 to 7 is going to be the normal. We get it back down to 2s and 3s for a while. Yeah, refinance. But, where the housing market dropped off when they hit 8, that was a little high, but it wasn't really high. I mean, to us, it feels really high, but It wasn't. And people need to understand that interest rates and inflation are tied together. This was an uptrend. It happens. And they're already having interest rates come down. So as inflation has come down.
Yeah, we're going to talk about that. I think 2 points I'll add is, number one, I think you're right about the rates where we are now being more normal than what we experienced when we had near 0% interest rate environment and virtually no inflation. I think part of what was being dealt with was just a shock of it going up so fast. It
Mhm.
seemed to change in such a short period of time. In fact, it did. So that was kind of shocking. And then the other point I'll make is that it seems like Americans, investors included, are still a bit prickly about the food inflation. It's something that they deal with every day, the price at restaurants, the price at the grocery store. And it still is something I don't think a lot of Americans have completely settled in on, that we're not going to go back to food prices that we had before, that this inflation that we experienced in food, and it's still going up, is not going to retreat. And I think that has kept Americans a little on edge and in a little bit of a sour mood about things. Do you think that's a fair description of how Americans are viewing inflation, especially related to food, which they spend money on every day?
I do think that's fair. Now, I am the grocery shopper in my household. So I see the prices and I get shocked. Maybe I'm giving my age, but I remember, you know, 65 cents for milk and eggs are under $1. And now we get these cage free, everything else free, and they're $5 a dozen. And it blows my mind.
Sure.
But food prices, went up, they'll stay up. And I even caught on to a little trick they're doing to keep prices down. Make the packages smaller.
Oh, yeah. Yeah.
My favorite is Hershey bars. And I used to buy the big ones, and
Yes.
they're half as thick now and the same price.
Yeah. Yeah. I think that's, I did a podcast episode on this about shrinkflation, because not only have prices gone up, but sizes of goods and services, food, as well as cleaning supplies, toilet paper, paper towels, have also shrunk, which means you're getting less for your money. So we talk about inflation, how it's come down a lot. And the Federal Reserve, it seems to me, deserves a lot of credit for the handling of inflation recently. I think it's also fair, and I did this on previous economic updates as well as the podcast, is that they deserve a lot of criticism early on because they were slow to react to the building inflation problem. I
Mhm.
think, though, since they swung into action, they've largely been effective. That's why inflation has come down. They've been able to thread the needle a bit in bringing inflation down while also not doing a ton of harm to the economy. We're going to talk about that in a few slides. But where we find ourselves in early 2024 is that they're in pause mode. They haven't raised interest rates for several months now after going on quite a binge of raising interest rates. They were as aggressive as they've ever been in their history. So now we're in this pause. Let's talk a little bit about the pause. And you made the point a moment ago about the expectation for interest rate cuts. So let us know what you're thinking about this pause and what happens next.
Well, we really do need to discuss it's a pause. And the markets at the end of the year priced in early cuts. And when the minutes from the Fed came out and showed that it was more of a pause than a cut quickly, the first 2 weeks of the year were very rough. We had, negative markets because, people hear what they want to hear, and then they bake in a first quarter cut to the market expectations. And when the
Right.
Fed said we're going to pause, we will cut eventually, but not right now, the market reacted very negatively. And then as people digested it, a week and a half ago, the market started taking off again, and we've had new highs. And we just need to understand that none of this should happen overnight. They have to go slowly. If they immediately cut everything, it'll just undo everything they did. Just as they were slow to act in the beginning, they need to be cautious and appropriately act now.
Yes. And with the appropriate action, it's worth mentioning that when inflation was raging, seemingly out of control, there has been a lot of talk over the last, let's say, 24 months, perhaps longer, about a recession. I've been in the business for 32 years. I know you've been in the business a long time as well. I don't want to give away your age necessarily, but I've never seen an instance where a recession was imminent, yet never has actually arrived. Now, maybe we will get a recession in 2024. That's possible. But the risk when inflation was at 7, 8, 9% was that we might be in store for a nasty recession, a deep recession, and maybe one that lasts a long time. That risk has evaporated. Almost no one, except maybe your rare doom and gloomer on the internet. But in the mainstream, the risk of a recession has gone down dramatically. And even talk of any recession that you might have is mostly around a shallow, short recession. That's sort of the tail or the end of this episode we went through. But it seems like a recession is off the table. You agree with that conventional wisdom, no?
100%. And I don't think we're going to have anything bad going on. We need to watch what's going on, but also we're going to get some opportunities with this.
Yeah, I think so. And what has replaced the recession thinking has been this idea of a soft landing. And I will say with some pride that back in the middle part of 2023, I did an episode on the podcast, Dreaming of a Soft Landing, and talked a little bit about how the ingredients were sort of in play where you might have a soft landing, which in simple terms is the idea that the Federal Reserve would be able to wrestle inflation under control, but do so without doing undue harm to the economy, not wreck the economy, and sort of like land the jet or land the commercial airliner smoothly in a very delicate way. I used the term a few moments ago about threading the needle. That's another way to look at it. They want to get inflation under control, but they don't want to do undue harm to the economy. It seems like they are increasingly in position to negotiate a soft landing, which is not easy to do, but the signs are there. Inflation has come down. We're going to talk a moment or two, or a slide or two. We'll talk about the healthy job market and the healthy consumer, but that seems to be where we are. And that's the conventional wisdom, is that we're going to have a soft landing. Inflation will come under better and better control. The Federal Reserve will be in a position to cut interest rates. That is embraced by the markets. It's thought that that'll do well for the economy, and we will not go into a recession, even though it was often predicted. Is that a kind of a good summary, Marshall?
That's an excellent summary. I agree with everything you just said.
And so the soft landing is the best case, and that is cause for great optimism that the economy could grow. As of this recording, by the way, the GDP numbers for the fourth quarter came out today. I don't know if you had a chance to see it, Marshall. I know you have a busy day, but in the fourth quarter, we came out with annualized GDP growth of 3.3%, beating estimates and showing that the economy, although it has difficulties and challenges and problems, actually accelerated into the end of the year. That is a good number, beating expectations, and is further cause for optimism as we move further into 2024.
I agree totally.
Yeah. So let's talk a little bit about the labor market. One of the things, Marshall, that was often talked about when the Fed swung into action and started raising interest rates aggressively was that they would have to create a lot of unemployment. That's the damage I talked about earlier. But that didn't happen. The unemployment rate remains low by historic standards. It's a healthy market. What do you make of this strong labor market, and included in that, why inflation was able to come down and not have the expected increase in unemployment?
Well, I think that a lot of the people that we deal with are small business owners here in Florida. Okay.
Sure.
And their labor market, they're still trying to find out. It's an extremely tight market and wages have been going up to attract more people. We are seeing some of the larger corporations announcing layoffs, 5%, 2%, 1,500 jobs, 1,000 jobs. But these are companies that, when money was cheap, put on more people than they probably should have.
Right.
Now they're writing it. They're not contracting because business is bad. They went too far, and that's the thing. People have to balance. So we are seeing some layoffs in news, but I
Yes.
think the job market is still fantastic, and I wish it was this good when I get out of college and was looking for a job.
Yeah, me too. Yeah, me too. I went into the job market in 1992, and it was a pretty unhealthy economic environment. It's a job hiring market at that point. So I understand where you're coming from. Uh, Jordan Jackson on the first version of the economic update that we here at Elliott Wealth Management put out, he and I talked about this. My thinking is, and I'd like your take on this, is that part of the reason why why inflation came down without the corresponding damage to the economy and the job market as expected is just the weirdness of what we're going through, because a lot of this originated not from primarily economic events, but rather primarily an epidemic, the COVID, or pandemic, I guess is the right word. So it's not really a natural economic event. So there's a little bit of a distortion as to what's happening and why. So we've kind of defied economic textbook activity, including on the unemployment front. But I think it just is because it's weird. This all happened because of the pandemic and the unnatural closure of economies around the world. So do you think that kind of makes sense on why things have played out a little differently than would normally be predicted?
I do agree, but I want to add that the pandemic also changed the way we work. So the
Yeah,
pandemic forced a lot of people to work from home.
great point.
A lot of people to change jobs, and a lot of people don't want to go back to the traditional job. We have a lot of people that left their positions and opened their own business, and a lot more working from home or doing side hustles or what have you. And some of that's permanent. Some of the spike in the unemployment is people that don't want to go back to the workforce because they're doing something else or they've retired or what have you.
That's right.
So, we have to understand that we always get new normals, and this may be more normal.
Absolutely. And given that COVID is really a profound experience for the country and the world, the effects, the changes are profound as well. And I think that relates to this next slide, which talks a little about the US consumer. Uh, 70% of the US economy is based on consumer spending. It really is a primary driver of what happens in the economy. And the consumer coming out of the COVID pandemic, the lockdowns, the consumer has been very active, very strong. If you're listening to this anecdotally, you could observe this. If you go to a restaurant, they tend to be filled. Airports, hotels, sporting events, music venues. I mean, it seems like Americans are still out trying to catch up for lost time and sort of trying to live life to the fullest. And that means a lot of spending. So that has slowed some recently, but the consumer seems to be pretty healthy and pretty active. What are your thoughts on that?
Again, I'm in a service area, so we have no major corporations here. But I look as I drive home at the skyline, and I can measure how good the economy is doing by how many cranes I see. The big cranes that build the big tall buildings.
Sure. Yep.
It, the coast is cluttered with them. As I drive up and down the intercoastal, I see house after house being built. Going down, bigger ones being built and bigger and bigger. As you said, every restaurant. I've never seen the restaurants as full in the last 15 years as I did this year. The parking lots are full. People are out and they're spending and they're living their lives. And there is a segment that I'm sure had to cut back and had to change. And maybe instead of a $200 restaurant, they're going to a $150 restaurant. Or instead of going out 4 times a month, they're going out 3 times a month. But people are out spending. You go into the Lowe's and the Home Depots, people are buying. You look around, I see the yards getting redone. And just
Oh,
my
yeah.
neighbor's phone, I see the landscaping people there all the time now for major redos. People are spending. They're getting more
I agree.
comfortable, and they're spending the money.
I
It's
will I will push back a little bit though, because Marshall, you reside in Florida,
mhm,
and Florida is by and large a state that's winning the economic competition around the
right.
country, and
Mhm,
there are winners and losers. So I recently relocated from Connecticut to Florida, but I still currently have a home in Florida. I mean, in Connecticut. And you don't see the cranes in Connecticut. And Connecticut is a state, and we could do a whole nother episode about this. But Connecticut and a lot of the surrounding states are generally losers in the economic competition, where you have businesses moving out, people moving out, a lot less economic dynamism just because of taxes, weather,
mhm.
political environment, cost of living. There's a whole variety of factors. But like when I'm in Connecticut and I look around, I don't see the vibrancy I do in Florida. And there's other places too that are big winners, Tennessee, Nevada, North and South Carolina, I think generally, and I'm probably leaving some out, are big, big winners. And then areas like California, Illinois, New York, Connecticut tend to be losers. But even in those states, the consumers are still out there spending. I mean, a restaurant in Connecticut's just as full as a restaurant in Florida. So the point still stands about consumers doing pretty well.
No, I agree. And certain areas are going to work, be affected differently than others. And I see a different segment being where I'm at. But I see people spending money. I've been to
Yeah.
airport, the holidays. It amazes me every time there's a holiday, they say this is going to be the busiest travel weekend of ever. Well, how do you have a new ever 5 times a year?
So, unfortunately, in an economic presentation and outlook for a year, we need to address geopolitical unrest. There's a lot happening over the world. Neither one of us are, geopolitical experts, but I did want to touch on this because it is important, does have an impact, and it is on the minds of most investors as well as business owners. Is the fact that we still have a shooting war in Europe, which still seems strange to me. Fortunately, the conflict between Ukraine and Russia hasn't spread, but it's still a dangerous situation and can upset the economies around the world, especially if it should finally spread. It seems unlikely, but still a risk. And then more recently, with what happened in the Middle East in October, where you now have armed conflict between Israel and Gaza, you combine onto that this issue with the Houthis that are trying to choke off transportation in the Red Sea. So you have a lot going on. And I'm a little surprised, Marshall, and I'd like your opinion on this, that there hasn't been a little bit more of a negative reaction by the markets to any of these events, aside from just the tragic loss of life on both sides between Israel and Gaza. It's a little surprising to me that the markets didn't take a little bit more, that you didn't have a little bit of a sell-off or a little bit of a worry about the risks that are associated with this kind of armed conflict. Are you surprised too, or am I just
I'm a
worrying a
little,
little
I
too
am a little
much?
surprised, but we got to remember these are, and again, I'm not belittling any of this, but these are small regional areas. Don't forget, Israel and Gaza are the size of Rhode Island,
Yeah, true.
and Ukraine and Russia's bigger, but that's a couple of years old now, and unfortunately, isn't you don't see it every day in the news. And if you look back, the last few times Russia's done something like this, these conflicts have gone on for 10 years,
True.
and it's
That's
not
very true.
spreading. And unfortunately, we may be becoming a little desensitized and it's becoming normal. The things that are going on in the middle, in the like the Yemen area with shipping and the missiles, I think that's going to have a little bit more effect because shipping costs are going through the roof. I mean, container
Sure.
shipping is like $12,000 to $14,000 a container now instead of $4,000 to $6,000. That's not going to get solved very quickly. Um, but at the same time, with all these negative parts, don't forget they're using up so many weapons and equipment and fuel and other things that it's creating jobs, it's making manufacturing, it's putting whole industries back to work.
Yes. No, that's
So, I
true.
mean,
There are winners and losers through this economically. Unfortunately, for the lives of people involved in these conflicts, it's all negative, and we're saddened by that. But I agree, economically, it's always something to watch with the markets, because if something surprising happens on the negative side, it could derail what is perhaps an optimistic tone for this year. Uh, but so far, so good on that front. So as we kind of get to the latter stages of what we wanted to present to you, listener, viewer, let's just summarize, talk about some causes for optimism that we have. We've already talked about them, but manageable inflation is a cause for optimism, and that the Federal Reserve has moved into a more passive stance. Seems quite unlikely that they would raise interest rates again. And as we've already talked about, there's the possibility of interest rate cuts this year, the likely possibility of interest rate cuts this year. And all of these have been embraced by the markets and seem to be a key ingredient on why the stock market in particular finished 2023 on a very positive note and has shown signs of strength in the early going in 2024. We also have reduced recession fears, almost eliminated, actually. And
mhm,
then we've already talked about, we have low unemployment and a healthy consumer. Of course, those are related. When people have a job, they tend to feel more optimistic. When they're
I
bringing in a
agree.
regular paycheck, they often feel empowered to spend and live their lives. When you have rising unemployment, you often have that coupled with a less healthy consumer. So I know that was a brief overview. Marshall, anything you want to add to that?
That's all right on. I've got a couple comments, but I'm going to wait until we start summing up what we do, and I'll bring them up then.
Yeah. And then, of course, there are things to worry about. Um, for me, one is the excessive rate cut expectations. This idea that has taken hold in some circles about the Fed cutting interest rates maybe as much as 275 basis points in 2024 seems to me at this point to be a little far-fetched. I can expect reasonably that the Fed would stay in pause mode and begin to cut rates, but I don't think they'll be too aggressive. I don't think there's any momentum for them to do that. I think that has too much risk for them. I think going slow will be fine. And I think some people then will end up being disappointed. And that disappointment may interrupt this market rally. So that's one thing I want to watch for. The second thing is the sour mood of the American public. If you look at polling, right track, wrong track, consumer sentiment It's been negative. It's perked up a little bit recently, which I think is a positive turn of events. But going back to what I said earlier, Marshall, about Americans being in a little bit of a sour mood, I think in part to the high food prices, that's a little worrisome. We also have this geopolitical tumult we talked about. It might be a small risk in terms of likelihood of becoming impactful, but if it does become impactful, it can potentially change a lot and in a hurry.
I
And
agree.
then the last thing that we put down is this election craziness. Marshall, as I've been speaking with clients, I've been talking about it as, this election will be a zoo, the likes we have never seen before. And depending on one's political views, they may have outsized optimism or more harmfully outsized pessimism about what's going on. And sometimes that could lead to poor investment decisions. And that's part of what we want to hold the line on as we help clients win with money. Uh, Anything to add there?
Especially the last point, the election craziness. I mean, we're still a year away from the general election, and I'm already fed up and sick of it. And I wish I could find the fast forward button on my TV to get rid of all the ads. And it's just going to get worse. And it's just something that we need to get through and move on, but we can't let it take over everything.
I agree. I took this slide from the JP Morgan research that they provided us that Jordan Jackson and I talked about on the first version of the economic update. And I think it's pretty powerful. And I know this. I don't know the numbers, but I know this. And you know this also. But I draw people's attention to during Barack Obama's term in office, which lasted 8 years from 09 to 17, the market averaged 16.3%. And that's good. Now, I think as a citizen, as a political watcher, we could debate whether President Obama did this right, did that right. Should he have pursued this policy or would he have been better off doing that? We could debate all of that. But 16.3% is strong. He was replaced by President Trump. Now, President Trump and President Obama have very little in common. But during the Trump administration, even with the impact of COVID, the average return was 16%. So the market prospered under a Democrat and it prospered under a Republican, even though they were very different personalities, ran their administration differently. The world had different challenges. But I think that's pretty telling. Granted, as of JP Morgan's research, which was through the end of 2023, under President Biden, the return has been less. It's been 9.2%. Now, maybe some of that's President Biden. Maybe all of it's President Biden. We could also debate that. But 9.2% certainly isn't the sky is falling either, and everything is going to come to a grim end very soon. So I caution listeners to not put too much emphasis on their political views into their investment decision making. It can be part of it. I think that's legitimate because the different policy prescriptions that one president versus another president might mean different investment strategies to a certain point. But this idea of the sky falling should be sidelined, I think. What do you
Absolutely
say on that
agree. I
subject?
mean, both of these had good rates of returns. The market's going to do what the market's going to do, and we need to look at where can we uh, make better choices and better plans going forward. And we have several opportunities right now. When interest rates come down, bonds go up. So, but when interest rates go up, bonds come down. We just went through a period where rates went up, bonds went down. We're fairly certain that rates are coming down. I started going a little longer on my bonds, saying, one, I'm getting a decent rate of return, and two, it gets an appreciation when interest rates come down. So there are opportunities regardless who wins here. And,
Yes.
the best outcome we can hope for is a functioning government
well,
opposed to a stalemate. I mean, that's
we
really
could
what we're looking for.
we could debate whether we'll end up with a functioning government, but that we could save
I
maybe
said
for
we
a
can hope
political
for it. I
talk
didn't
show.
say we are
Yeah.
getting it or not.
So once again, Marshall, thank you for joining me. Listeners, viewers, thank you for attending this presentation of the economic update. What you can expect from us is the team here at Elliott Wealth Management, the expanded, deeper, more powerful team here at Elliott Wealth Management are going to regularly review changes that impact and affect you. You can expect regular communication from us. This economic update, as well as the first version with Jordan Jackson from JP Morgan, represents that. We have the Simply Financial podcast. We do a monthly mailing. We will have updates on our website, elliottwealth.com. We are going to consistently review economic, tax, estate, and other investment issues for our clients. So if you're listening to this and something has changed on your end, whether you're a client or not, please reach out to us. You could do it through the website. You could call the office, email us, but please reach out. We are here to help you, and your health, your well-being is our highest priority. The team and I, we really appreciate the opportunity to help you with your financial needs. We are here to help always with your planning needs so that we could have success together. Marshall, closing comments.
Thank you for inviting me on this podcast. And right, this is a time where we need to be in touch even more often than we have in the past. There are a lot of things coming up. None of them bad, good, but a lot of opportunities.
Yes,
Some people have concerns. We have a looming tax change coming up in a year and a half. I mean, there are things that we need to have discussions on, and it is time to speak more regularly than we have in the past. And maybe make some people a little bit uncomfortable in the discussions, but they have to make intelligent decisions and be aware.
that's right. And we are here to help them make informed, non-emotional, well thought out decisions as much as we possibly can. So we'll leave it there. Again, listener, viewer, thank you for attending this. We will be back with you with more updates, more information so that we could help you win with money. Thanks again.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.